Push a button in the right building in Singapore, and instead of a candy bar, a Ferrari slides down 15 floors to meet you. A used car dealer there ran out of floor space, so he built a glass tower that dispenses Ferraris and Lamborghinis the exact same way a hallway machine dispenses a bag of chips. Tap a screen, wait 2 minutes, a lift delivers the car to street level. It cost him roughly $2.15 million to build. Sales rose 30% the year he opened it. Most people watching that lift come down see a novelty. An investor sees something simpler than that, a box that makes money without ever needing to pay someone to stand next to it. That is the same unglamorous idea quietly producing tens of billions of dollars a year out of hallway snack machines nobody has ever thought twice about, and in 2026, with wages climbing faster than almost any other cost on a retailer's books, that idea has never looked better. Here is the thesis, and everything after this sentence is just proof of it. Every time a cashier disappears from a transaction, someone keeps the wage that cashier would have earned. That is the whole business, whether the box is selling a candy bar for $1.50 or a gold bar priced against the live market. A vending machine is not a clever gadget. It is a paycheck that stopped existing, and the money that used to go into it now goes to whoever owns the box. The first person to prove that out at scale was a gum manufacturer named Thomas Adams, who in 1888 bolted a coin-operated machine onto a New York train platform so commuters could buy Tutti Frutti gum without a clerk standing there to sell it. He probably was not thinking in terms of return on capital. He was thinking about rent and about not paying someone to stand on a train platform all day. The machine has changed almost beyond recognition since then. The reason someone builds one has not changed at all. Estimates put the global vending machine market somewhere around $25 to $28 billion a year right now, with several forecasts projecting it could climb toward 30, maybe close to 50 billion within a decade. That is faster growth than general retail is managing right now, at a moment when general retail is getting squeezed by rising wages and rising rent almost everywhere else. This industry sits behind office break rooms, hospital corridors, and factory floors on every continent, run partly by small operators nobody has heard of, and partly, as you are about to see, by a handful of enormous companies you have definitely never heard of either. And the reason it works comes down to one number that should honestly embarrass most restaurants: gross margin. A well-stocked snack and beverage machine routinely runs between 50 and 65%. A restaurant loses 28 to 35% of revenue to food cost alone, before it has paid a single server or a single dollar of rent on the dining room. A vending machine has no server, no dining room, just a box, a location, and a restocking schedule. That is the whole cost structure. And it is why the boring, disciplined operator beats the ambitious one almost every single time in this business. Now, put a real number on it, because the industry's own trade group has already done the math. The National Automatic Merchandising Association's most recent census puts average annual sales per machine at around $6,284, or roughly $524 a month. On its own, that sounds almost disappointing, but the machine costs $2,000 or $3,000 used, needs no employee, and takes maybe an hour of your time a week. 16 machines like that clears $100,000 a year in gross sales, and industry brokers estimate net profit per machine can run north of $1,600 a month once the route is running well. Good locations, a tight restocking schedule, minimal shrinkage. Do that math against what it actually costs to buy the machines, and you get a payback period most private equity funds would take in a heartbeat if the deal were not too small for them to bother with. Picture what that looks like on the ground. An operator loads a cargo van with chips, sodas, and protein bars before 6 a.m. and pulls up a route on a phone that already knows, thanks to a sensor inside each machine, exactly which slots ran dry overnight and which ones still have 3 weeks of stock left. 15 stops. A factory floor, a community college, 2 dentist offices, a tire shop. No employee handoffs, no shift schedule, no landlord negotiation beyond a standing commission split with whoever owns the building. By early afternoon, the van is empty and the day's work is done. That is exactly why this business keeps pulling people out of office jobs and into vans like that one. Not the promise of getting rich, the promise of income that does not require a person standing behind a counter to keep coming in. There is an entire secondary market built around exactly that appeal. Vending routes get bought and sold the way small franchises do, priced as a multiple of net profit rather than gross revenue, typically somewhere between 1.5 and 3 times annual net. A route grossing $210,000 a year with an $80,000 net recently sold for $175,000, just over a 2 times multiple. Brokers call the intangible part of that price blue sky, the signed location contracts, the relationships with property managers, the simple fact that someone else already did the hard part of getting the machines placed in the right hallways. Buy that, and you are really buying a cash flow someone else already de-risked for you. You skip the slowest, most frustrating year of the business, the year spent cold calling office managers and factory foremen, getting told no, or worse, getting told yes and then watching the location underperform for 6 months while you figure out whether the problem is your pricing, your product mix, or just bad foot traffic. That homework matters more than it sounds, because vending has always been a cash-heavy business. And cash-heavy businesses have books that can lie. Anyone who does this seriously will tell you to check a seller's claimed revenue against actual product purchase receipts, because it is disturbingly easy to underreport a route that runs mostly on coins and crumpled bills. The pitch, quit your job, buy some machines, sit back and collect, is real. It is also a business with the same fraud risk as any other cash-heavy trade, and the people who actually build wealth here are the ones who treat it like a spreadsheet, not a dream. Now take that same idea and scale it up by roughly 6 orders of magnitude. And you get Selecta Group, a name almost nobody outside the industry has ever heard, despite it being one of the more instructive private equity stories in Europe. It started in 1950 with a Swiss factory worker named Joseph Jaeger, who took a business trip to the United States and saw vending machines humming quietly on American factory floors, selling coffee and snacks without a single cafeteria worker in sight. Jaeger spent his entire life savings on 5 of those machines and shipped them back to Switzerland. That original employer is still a customer today, 75 years later. Selecta now runs north of 300,000 machines across Europe, brings in well over €1 billion a year, and is owned by Kohlberg Kravis Roberts, one of the largest private equity firms on earth. That ownership tells you everything about how big money treats this business once it gets large enough. Buy the market leader, absorb every regional competitor that comes up for sale. Run it like infrastructure instead of a snack company, and borrow against it accordingly. But debt cuts both ways, and even at this size, the business is not bulletproof. In 2025, Selecta had to inject hundreds of millions of euros of fresh capital just to refinance its existing debt, and a group of creditors left out of that deal sued in U.S. court. The largest vending company in Europe, backed by one of the biggest names in private equity, nearly buckled under its own leverage. It is the same lesson every lender already knows and every excited investor keeps forgetting. Even the safest, most predictable cash machine on earth is not safe if you pile too much debt on top of it. There is a second cost buried in this business that never shows up on a forecast slide. Because a vending machine has no one standing behind it, it also has no one standing in front of it to scare off a thief. Talk to any operator running routes in the wrong part of a city, and you will hear the same story eventually. A machine gets rocked, cracked open, or hauled off overnight, taking the cash box and every dollar of inventory with it. Enough of that on enough routes, and an operator simply stops servicing a neighborhood no matter how much foot traffic walks past it every day. Nobody prices this into the pitch. Taking the human out of the sale does not just take out the wage. It takes out the one thing that used to make a thief think twice. And anyone serious about this business prices security and location quality just as carefully as they price the margin on the chips. Which brings us to a very different kind of stress test, because a trusted brand and a captive customer are not, on their own, enough to keep a business alive. In 2008, Best Buy started installing vending machines in airports. Real ones, kiosks stocked with headphones, chargers, and GoPros, sold at retail prices, with returns honored at any Best Buy store. Within a decade, there were roughly 200 of them, spread across more than 50 airports in the US and Canada. And the pricing tells you exactly how much people will pay when they have no other option. A phone charger that costs about $3 wholesale sells for $15 in that machine. A pair of Beats headphones that runs $299 in a normal Best Buy store sells for $379.99 at the gate. And people buy it anyway, not because they missed the markup, but because the alternative is not a cheaper charger down the concourse. It is a dead phone and a missed flight. That machine is not really selling electronics. It is selling the fact that there is nowhere else to go at whatever price it wants to charge for that. So, on paper, this should be one of the best businesses in retail. Trusted brand, captive audience, almost no competition, huge markup. And yet, the company actually running those Best Buy kiosks, a firm called Zoom Systems, went bankrupt anyway. The brand name and the airport foot traffic and the 5 times markup on chargers were not enough, because underneath the shiny electronics, it was still a vending machine, still completely dependent on keeping the machines running, restocking them on time, and stopping theft on inventory worth 10 times what a candy bar machine carries. The lesson is simple. This business rewards discipline, not a famous logo. The second someone starts treating it like glamorous retail instead of unglamorous logistics, it stops working no matter how nice the product behind the glass is. Which sets up the most interesting growth story in this whole industry over the last decade. And it did not come from electronics at all. It came from lettuce. In October of 2013, a recent college graduate named Luke Saunders put a single prototype vending machine in a downtown Chicago food court, stocked with jarred salads instead of chips. He spent his own savings building it and did not sleep properly for a month afterward. 100 years of vending machine design had been built entirely around products that could sit behind glass for weeks without spoiling. Saunders was trying to sell fresh, hand-cut vegetables through the exact same format that had spent a century perfecting the candy bar. And there was no blueprint for that, so he built his own refrigeration and inventory systems from scratch. It worked. By 2018, Farmer's Fridge was running nearly 200 machines across Chicago and Milwaukee, and a venture fund run by former Google CEO Eric Schmidt handed the company $30 million to expand into offices, hospitals, and college campuses across the Midwest. The investors backing that round made a point that should worry anyone still running old-fashioned vending machines. Less than 5% of vending machines in America had any way to track their own inventory in real time. Saunders had built one that did, which meant he knew exactly which machine in which building was about to run out of a specific salad before it happened, a level of visibility most of this industry still does not have. Then the crisis hit all at once. In March of 2020, the pandemic emptied out every office building, courthouse, and hospital lobby the company depended on. Revenue dropped 85% in a single month. Of 355 installed machines, only 160 were still worth running. This is the one weakness every version of this business shares. There is no floor under the revenue. A machine cannot sell to someone who is not standing in front of it, and unlike a restaurant, it cannot simply start doing delivery on its own. Saunders' answer was to stop thinking of the company as a vending machine business at all. Within weeks, Farmer's Fridge pivoted to nationwide delivery, raised another $40 million to fund it, and got its jarred salads onto the shelves of Aldi, Target, Walmart, and Jewel Osco, building an actual grocery business the company would never have needed if the pandemic had not forced the question. Today, it runs more than 2,000 machines across roughly 20 states, and the part of the business that once made up 40% of revenue now makes up about 10%, because the company spread its bets instead of staying tied to a single format. It has sold more than 31 million meals since 2013, growing at close to 75% a year, and expects to sell 10 million meals in 2025 alone, a third of its entire lifetime volume, sold in a single year. That is the kind of business worth backing. Not just a box, but a company willing to stop being defined by the box the moment it had to. That is this whole industry in miniature, an idea. Early success, a crisis nobody saw coming, and survival by refusing to stay small and single-minded. Which brings us to Japan, the closest thing on Earth to a national-scale experiment in this exact business. Somewhere between 4 and 5.5 million vending machines are running there right now, roughly one for every 23 to 30 people, the highest density on the planet, and the reasons are mostly economic, not cultural. Start with theft. Japan has extraordinarily low rates of vandalism and petty crime, so an operator can leave a box full of cash and inventory unattended on a quiet street overnight and barely think about the risk of loss. Move that same machine to the wrong corner of almost any other country, and the math falls apart. This is a business built on removing the person from the sale, and that also removes the person who would have scared off a thief. Japan is the one place on Earth where that trade-off costs almost nothing, which is exactly why the machines there sell things nobody would trust to an unattended box anywhere else, hot bowls of ramen included, sitting right next to a machine selling canned coffee to someone on their way to catch a train. Then there is the engineering. In the 1970s, manufacturers there solved a problem that had been capping revenue for every vending machine on Earth: seasonality. They built machines with sealed compartments that dispensed some drinks piping hot and others ice cold from the exact same unit. That is not a fun fact for a travel show. That single fix doubled the selling season for every machine on the street. And that is the only thing that actually matters to whoever owns it. And there is the lesson in what finally slows even the biggest lead in the world down. Japan's machine count is shrinking now, slowly, year over year, not because of a law and not because of theft, but because convenience stores like 7-Eleven and Lawson simply offer more choice for about the same weight. That is the one weakness this business can never fully design its way out of. A vending machine wins on speed and margin, and the moment something nearby offers more selection for roughly the same convenience, it starts to lose. America already ran a version of this exact test decades earlier, and it was not a competitor that ended it. It was a law. Cigarette machines were once everywhere in American bars and diners, one of the most profitable product categories the industry had ever seen. Regulators, worried about underage access, effectively wrote the category out of existence. The machines did not lose to a better machine down the street. They lost to a signature on a bill. That is the second permanent risk sitting under every vending business. It only works as long as whatever it sells stays legal, lightly regulated, and easy to restock. Change any one of those things, and the machine goes dark, no matter how good its margins looked the week before. So when a company called American Green decided in 2014 to build a vending machine that dispensed actual marijuana in Colorado, it built the legal risk directly into the machine instead of getting blindsided by it. Later, the way the cigarette business had been. The machine, called Zayas, would not open until a customer swiped a driver's license, and internal cameras used facial matching to confirm the person standing there was actually the person on the ID. The dispensary owner who installed the first one was blunt about why he wanted it. It stopped internal theft, cut out a layer of labor between his staff and his inventory, and gave regulators a fully recorded transaction trail instead of just trusting a cashier's word. Cannabis vending machines have since spread wherever the law allows them, and everyone is running the same playbook. Build the compliance in from the start, because this industry has already seen what happens when a category does not. Behind almost every one of these machines, whatever they are selling, is a surprisingly small group of manufacturers quietly building millions of connected boxes for operators who care far more about uptime than branding. But the part of this business that has grown fastest over the last decade is not the box at all. It is the layer you cannot see, sitting inside it. An Israeli company called Nayax spent years building nothing but the payment terminal, the little screen that lets you tap a card or a phone on a machine instead of digging around for coins. It sounds boring, and it is. But by the time Nayax listed on the Tel Aviv and Nasdaq stock exchanges, it was processing payments through more than 370,000 points of sale worldwide, with revenue past $100 million a year, growing at a pace most retailers would kill for. Almost nobody tapping their card on a vending machine has ever heard of the company making that tap work. That is the real story behind the cashless shift. The box you can see is rarely where the money is actually made anymore. It is the payment system, the inventory sensor, and the remote alert running quietly behind the glass. And that hidden layer is growing faster than the machines themselves. Roughly three-quarters of vending machines in the US now take contactless payment, and connected, smart vending remains the fastest growing part of the whole industry, expanding at nearly double the pace of everything else. And once you realize the machine itself is not really the product, just the automated salesperson standing between a customer and whatever sits behind the glass, you start to understand why that glass can hold almost anything at all. It also explains why this whole category stopped looking like a curiosity years ago and started looking like a preview. Self-checkout lanes at the grocery store, package lockers on the corner, cashierless stores that unlock with an app instead of a clerk are all running the exact same trade this industry has run for over 100 years. Take out the labor, keep the margin, and let a machine carry the risk a person used to carry. Vending did not copy that idea from modern retail. Modern retail, heading into 2026, is still catching up to what this industry solved with a coin and a spring a long time ago. Which brings us to Abu Dhabi and the gold. In 2010, a German entrepreneur named Thomas Geisler installed a machine called Gold to Go inside the Emirates Palace Hotel, an ATM-style kiosk dispensing real 24-karat gold bars and coins, priced against the live market rate and updated every 10 minutes over an encrypted connection. It sold out within a day. Not because gold got cheap, because people will pay a real premium for the exact same thing that makes a snack machine profitable. No salesperson, no negotiation, no wait. At any price the hardware can be built to handle. Geisler's machines eventually spread into the Burj Khalifa and Gulf shopping malls, each one running the same basic math as a soda machine on a factory floor. A fixed cost for the box, a variable cost for the inventory, and a margin wide enough to never need an employee. None of this needed the machine itself to look any different from the one your grandfather fed a coin into. That is exactly why this business is so easy to overlook. It stays boring on purpose, because boring is what lets a machine sit in a hallway for 20 years without anyone asking why it is there. The moment this business starts looking exciting is usually the moment something has gone wrong, a bankruptcy, a recall, a machine finally broken into. Everyone who has quietly won in this space learned the same discipline. Keep the box invisible. Keep the sale instant. Let the boredom do the work. Line all of these up next to each other. The Swiss factory worker who spent his life savings on 5 machines and built a billion-euro company. The Chicago college grad who did not sleep for a month over jarred salad. The Colorado dispensary owner who built ID checks into a machine to get ahead of a law before it arrived. The Israeli engineers who got rich building nothing but a payment screen. The Singapore car dealer inspired by his kid's toy collection. The German entrepreneur who put actual gold behind glass. None of them were really in the vending machine business. They were all in the same business, figuring out which sales can survive once you take the human being out of the middle of them. Some cannot. Best Buy's electronics kiosks could not, even with a trusted name and airport-level markups behind them. Cigarette machines could not, once the law caught up with them. Even Selecta, the biggest player of all, nearly could not, once its own debt caught up with it. But the ones that survive, the salad jars, the gold bars, the Ferraris on a lift, the $6,000 a year snack machine humming quietly in a factory break room, are all running the exact same engine underneath. For more than a century, people thought vending machines were selling snacks. They were not. They were selling the one thing modern retail is still chasing right now, in every self-checkout lane and every locker on every street corner. A transaction with the labor already removed.